So there's certainly a few things about this downturn in early April that are quite unique. So historically, and certainly over the last several decades, policymakers, whether it's central banks or governments, have typically played the role of helping to backstop markets during periods of unease and stepping in with whether it's interest rate cuts or fiscal stimulus as well. In this particular case, of course, with a trade war initiated by the US on much of the rest of the world, it's actually the government that's initiating some of this volatility. So that is quite unique. At the same time, really kind of increases the uncertainty around possible resolution, right? So resolution could come quite quickly, very hard to tell when, hard to tell if. That means that there's heightened uncertainty both in terms of how this may play out to the downside, as well as where a potential recovery may start to take hold. I do expect the volatility will remain elevated. And that part has been typical. After large drawdowns in the market, so large sell-offs, there will typically be a period of relatively high volatility where you may see very sharp rallies. Markets may gain very sharply based on rumors or some expectation of a shift in policy in this particular case, or new trade deals. And then that negative sentiment could return and you may see a further downturn. So expect higher volatility, something to just be ready to deal with, and important not to overreact to any of those large swings in the market. It's important for investors to stick to their plan, and more importantly, not to overreact to each and every rumor or headline or swing in the market. When we're in periods of high volatility, overreacting to any particular headline or potentially a movement in the market, you're often likely as an investor to actually get whipsawed, which means you're buying the market just when it's about to sell off, and you might be selling just when it's about to stage a recovery. Very hard for even professional investors to find exactly where that bottom in the market is going to be. Why it's very important to stick to that longer term plan. That means staying invested. That means adding to your investments as you've outlined in your investment plan, and continuing to plan for the longer term. Look forward to what your eventual goal is from an investment perspective. So secondary to staying invested and not overreacting to headlines, probably the most important secondary consideration is to be well diversified in your portfolio. So not all asset classes, equities and bonds, for example, react the same to different economic environments or changes in economic policy. So if there's a growth concern, for example, concern that the economy may be shrinking, in this case because trade is going to be severely restricted, equity markets, which are sensitive to slowing growth, will actually be falling, but higher quality fixed income investments, bond investments, will actually rise, and that provides some diversification benefit. The second layer of diversification is between different geographies, right? So if you're invested only in one market, only in the US equity market, for example, which has been a good place to be over the last couple of years, you can be overly exposed to a change in policy that's affecting the US economy more than other parts of the world. If you're well diversified investing globally here at home in Canada, in international markets, in emerging markets, there are different opportunities in different geographies will be impacted by a change in the global economic landscape to varying degrees. So there's a secondary layer of diversification that can be gained by being well diversified globally. So the grand portfolios are built to be resilient through times of uncertainty. Now there's a few layers to this. Diversification, as we spoke about, the grand portfolio is well diversified from an asset class perspective. So that means investments not just in equity markets, but in high quality fixed income markets as well, which gives some of that benefit of hedging against economic risks. Invested in different parts of the more alternative parts of the equity market, real assets, more defensive components of the equity market, which again can provide some relative outperformance in times of economic uncertainty. An additional layer, of course, is to be well diversified from a global perspective. The grand portfolios do invest globally, and we don't overexpose the portfolio to any single economy within the world. And then finally, we are big believers in active management. We select active managers who are really the best of breed in each and every asset class, with that ability to select those strong outperforming companies and leave behind those that may be a little bit more exposed to the risks of the day. We expect that active management to be a significant contributor in times of uncertainty.